The illusion of a bulletproof summer rally just cracked wide open. For months, retail traders have treated every single tech dip as a guaranteed money-making opportunity, blindly betting that artificial tailwinds would carry the S&P 500 and Nasdaq into permanent all-time highs. But over the past 96 hours, everything has changed. Michael Burry, the legendary Big Short manager who famously called the 2008 subprime mortgage collapse, has officially stepped into the light, and he's aggressively shorting the AI trade. Almost instantly, the market's psychological structure floor dissolved. Major tech staples that were heavily pumped last week are suddenly getting absolutely smashed on massive institutional volume. To make matters more terrifying, a massive systemic shock out of South Korea's tech index just triggered a massive emergency circuit breaker halt, sparking global semiconductor panic. So are we staring directly into the abyss of a historic tech sector rollover, or is this simply the ultimate algorithmically engineered shakeout meant to scare retail traders right before big tech launches a massive counterattack? Let's start by addressing the massive catalyst that sent algorithmic institutions into a frenzy this week. According to major reports across the street, Michael Burry has completely finalized a massive macro short position directly targeting the AI infrastructure trade. Michael Burry isn't just looking at minor multiple expansions. He's calling out structural late-stage retail overconfidence. Commentators like James DePore have pointed out the traditional positive July seasonality, which overconfident bulls completely relied upon, has completely failed to materialize this week. Institutional distribution is actively taking place while retail investors are left holding historically expensive, hyper-extended tech multiples. But of course, the bulls are completely unfazed by Burry's position, laughing it off as a repeat of his premature market warnings over the past decade. Enterprise software giants, cloud infrastructure names, and specialized network nodes are reporting real, robust contract backlog escalations. The secular growth demand for high-performing computing power is a long-term capital allocation wave that a single bearish macro manager cannot halt. To the bulls, this minor pullback is a healthy cleansing of short-term leverage, creating a massive buying opportunity before the next leg up. The bears argue that Burry's timing is absolutely impeccable. They point to the fact that major tech components like Micron and SanDisk have suddenly been smashed over the past few sessions, signaling a stark structural breakdown in institutional demand. The bear case rests on a brutal macro reality. The mass of billions of dollars spent on AI hardware have yet to yield proportional, high-margin enterprise software revenue. Corporate capex budgets are entering a strict structure saturation point. When these massive semiconductor orders inevitably get scaled back, the multi-trillion-dollar valuations backing the Nasdaq and the S&P 500 will face a historic multiple contraction. While domestic traders were trying to digest Burry's short, an international macro bomb exploded overnight. A sudden massive stock shock in South Korea sent its benchmark index into an absolute tailspin, forcing exchanges to trigger an emergency circuit breaker halt. Now, what was the epicenter of this global panic? Major systemic semiconductor manufacturers. For months, global tech portfolios have been entirely driven by global semiconductor FOMO. But the South Korea shockwave exposed a dangerous undercurrent of hidden leverage. As international institutional desks rushed to de-risk their portfolios, a brutal multi-billion-dollar margin squeeze rippled directly across the Pacific, impacting domestic tech heavyweights on the Nasdaq and dragging the S&P 500 into highly erratic defensive intraday behavior. The optimistic crowd insists that the international circuit breaker event is completely isolated and an operational anomaly that has absolutely no bearing on long-term U.S. technology dominance. They note that global demand demand for advanced hardware platforms, high bandwidth memory, and cloud infrastructure remains completely unhampered by short-term currency or margin fluctuations abroad. This forced institutional liquidation is actually an algorithmic gift for domestic investors, allowing them to snap up elite hardware stocks at a steep discount. The bears look at the international circuit breaker Halt as the definite canary in the coal mine. They argue that the extreme global semiconductor FOMO has created a fragile, hyper-interconnected domino effect where a single structural fracture overseas can instantly trigger an unhedgeable asset liquidation cascade globally. When global leverage starts to unwind, it doesn't matter how great a company's underlying fundamentals look. Institutional funds are mathematically forced to sell their liquid tech winners to cover their margin losses elsewhere, setting up a brutal structural trap for retail dip buyers. The final structural catalyst reshaping the S&P 500 right now is a massive quiet sector rotation that is confusing millions of retail day traders. For the past few months, a handful of hypercap tech names have completely masked the broader rot underneath the index. But recent updates from top market technical analysts reveal that the market's strongest performing sectors are suddenly showing severe distribution patterns. Leading defense and growth names alike are starting to roll over or are simply hanging out at dangerous technical breakdown boundaries. Institutional smart money is actively pulling billions of dollars out of momentum-driven tech plays and quietly rotating that liquidity into deeply defensive asset classes ahead of the massive U.S. employment jobs report. This is completely transforming daily market structure. The bulls view this sector churn as the ultimate sign of a healthy, sustainable, and broadening bull market. They argue that capital rotation out of overextended semiconductor names and into underloved consumer mobility, infrastructure, and traditional defense sectors prevents the market from building an isolated dot-com style bubble. As long as liquidity stays locked inside the broader S&P 500 ecosystem, the headline index will continue to stable out, creating a massive rotational foundation that will support a giant market surge into the back half of the year. But the bears argue that this rotation is actually a massive institutional exit strategy. Smart money isn't broadening the bull market. They're aggressively building up protective defensive moats because they foresee a severe macroeconomic growth slowdown ahead. The bears highlight that consumer credit metrics are maxing out and manufacturing metrics are stalling. Once this final rotation option runs its course and the broad market realizes tech can no longer carry the index weight, broader S&P 500 will face a simultaneous, highly synchronized market contraction. We are officially standing at one of the most significant structural crossroads of the entire market this year. With Michael Burry actively shorting the artificial intelligence theme, global tech index halts, exposing structural margin vulnerabilities, and institutional money quietly fleeing to defensive enclaves, the status quo has been thoroughly shattered. So I'm going to leave you with one defining question to think about tonight. Is this sudden, massive global chip pullback and failed seasonality the definite macroeconomic warning sign that Michael Burry is right? Or is this simply a giant, algorithmically manufactured trap designed to shake you out right before a massive summer melt up?